All right, question number 6. Question number 6. Is whole life insurance more efficient than the equity index universal life insurance policy? Now, once again, let me just preface, this answer by just saying whole life insurance is a proven product. I think all advisors who sell the IUL should have traditional whole life insurance products in their portfolio. Whole life is a more conservative product, but it's proven. Whole life has performed for over a century, right? It's proven. Whole life insurance products have paid dividends for a very long time with mutual companies. So whole life is a good thing. Let me say that. I am in no way, shape, or form against whole life and actually use it for my clients who are more conservative. Okay? Now, is it more efficient than the IUL? The answer to that question is no. The difference between whole life and the equity index universal life insurance policy, without getting too high level, if you will, and getting into an answer that's too stuffy, let's just say, simplified, a whole life insurance policy charges you as much as it possibly can on an annual basis. It charges you the guaranteed maximum amount of premium on an annual basis. And then at the end of each year, you are given back what's called a dividend, which is really a return of the overpayment of premium. So when I'm talking to clients, I can kind of use the parallel of overpaying your taxes, if you will. You may overpay your taxes and you'll get that money back when tax season comes, but you've basically given a loan to the government for anywhere from, from 1 month up to many as 16 months. You've given them a loan, right? So that was free money for the government. I look at whole life insurance the same way. There's nothing wrong with that because you are getting the money back, right? And you have the guarantees and peace of mind that your premiums will never go up because you're already paying the maximum amount of premium the maximum cost of insurance, that you'll ever be charged, right, for that policy. And you're being rebated, if you will, anything that's over the current cost of insurance. Okay, now let's look at that versus the equity index universal life policy and how it works. The equity index universal life insurance policy operates a little bit differently. Okay, the guaranteed amount that you could be charged for when having an IUL is higher than the guaranteed maximum cost of insurance in a whole life policy. Now, are you charged that higher guaranteed maximum? No, you're not. So although that you could possibly be charged instead of $100 per month, when the actual cost of insurance right now is, let's say, $50 per month in a whole life policy. So let me just backtrack for a second. In a whole life policy, just to be clear, you may be charged $100 per month when the actual cost of insurance might be, let's say, $75 per month. Okay? And then at the end of the year, you're basically rebated, if you will, the $25 in excess that you paid above the actual current cost of insurance. So you're giving that money back, right? But you'll never be charged more than that $100 per month. In an IUL, you might possibly be charged, let's say, $150 per month for the same amount of insurance in the guaranteed fine print of that policy. The insurance company will say, we could charge you $150 per month for this amount of insurance that the whole life company is charging you $100 per month for right now. You with me? But do they actually charge you the $150 per month? They do not. Whereas the whole life insurance company is charging $100 per month when the actual current cost of insurance is $75 per month, the Equity Index Universal Life Policy only charges you the current cost of insurance, which is $75 per month. So at the end of each year, there's no need for any sort of rebate or dividend in that policy because all you're ever charged is the current cost of insurance. Now, why is this important? Well, let's go back to the example of overpaying your taxes and receiving a refund. What if you did not overpay those taxes and you were able to take that extra $25 per month that you're paying into a whole life policy and you were able to invest that somewhere where it could grow at a rate of return of anything, let's say 4, 5, 6, 7% per year, just as an example. You would actually earn money that you are not earning currently because you're letting the IRS hold your money for over a year. So there's opportunity cost involved when you overpay your taxes, just as within a whole life insurance contract when you overpay your premium. Therefore lies our answer. An Equity Index Universal Life Policy, or IUL, is more efficient because you only pay the current cost of insurance on an annual basis. Although potentially the maximum cost could be higher, the chances of that happening are very low when you understand how the policies actually work.